Hello students. Today's my topic is Reserve Bank and monetary policies. The monetary policy of Reserve Bank of India is the crucial policy instrument for the economy to achieve and fulfilling macroeconomic stabilization. Coupled with the fiscal policy of the government, the monetary policy in India is designed and framed by the Reserve Bank of India to pace economic growth along with maintaining a stable price level. Stable interest rate, proper flow of liquidity, and controlling money supply, etc., are the key aspects of monetary policy. India's central bank, that is RBI, has aimed to adopt an efficient monetary policy using several instruments to attain growth in real GDP, lowering unemployment, and controlling inflation. As the apex bank in the country, RBI's prime focus is to controlling inflation with accelerating economic growth. Several economists in the past had criticized RBI's role due to its over-exercise towards controlling inflation than fostering economic growth. But recently, the scenario has been changed. Currently, RBI is dedicated to achieving higher economic growth to offset the negative effects of COVID-19 pandemic. To attain this goal, for the long time past, specifically till 3rd May 2022, RBI had kept repo rate either unchanged or slashed so that the economy could perform better by raising output quarter-on-a-quarter basis. Supply chain disruptions caused by the COVID pandemic and lockdown had raised the retail inflation in India. Geopolitical tensions, uncertainty in the international economy, and continuous rise in the oil prices in the domestic economy further intensified and raised the rate of inflation in India. For instance, CPI inflation in India in April 2022 was 7.79%, data source RBI. And this has forced the Monetary Policy Committee of the RBI to hike the repo rate in order to attain price stability agenda. Therefore, RBI raised the repo rate by 90 basis points with a target to achieve 4% within a band plus minus 2% CPI inflation in the medium-term target to support economic growth. Thus, the role of the RBI is very crucial in governing macroeconomy's stability and prosperity through the trade-off between inflation management and higher economic growth. The Reserve Bank of India is the apex institution in the monetary and the banking space in India. It was established on 1st April 1935 under the Reserve Bank of India Act. It was nationalized on 1st January 1949. The basic objectives of the Reserve Bank of India are: number 1, to accelerate and sustain economic growth. Number 2, to maintain a stable price level over the medium-term target. Number 3, to maintain credit and monetary system should be in balanced. Number 4, to ensure an overall balance and development of the banking and the financial sector of the economy. The RBI performs several functions which can be discussed now. Number 1, issuing currency note. The RBI is only having the monopoly power to issue currency notes. Only 1 rupee note and 1 rupee coins are issued by the Ministry of Finance, Government of India, but that is distributed by the Reserve Bank of India. RBI also exchanges old and damaged notes by issuing new currency notes into circulation. As per the minimum reserve system 1956, RBI need to keep a minimum reserve of 200 crores consisting of gold and foreign exchanges to issue new currency notes into the circulation. The next feature, banker to the government. RBI plays a significant role as a banker to the government, and RBI also plays the role as an advisor and agent of the government. On behalf of the government, RBI performs banking transactions, including exchanges and remittances. As a banker to the government, RBI provides short-term loan to the government under the Ways and Means Advances scheme, and interest on this loan would be charged at per the existing repo rate. Besides, RBI gives suggestions and advices to the government for the betterment of the economy. Next feature, banker to the banks. As per the Banking Act, all the commercial banks are needed to maintain a certain percentage of their deposit with the central bank, that is RBI, as cash reserves. In this way, the Reserve Bank is the custodian of cash reserves. If any bank faces any liquidity crisis, then that particular commercial bank may approach to the Reserve Bank, and Reserve Bank may provide liquidity against of government securities to the particular commercial bank. And that is why Reserve Bank is called the lender of the last resort. Apart from that, the Reserve Bank of India gives suggestions and instructions to all the commercial banks regarding the overall development of the banking and the financial sector. Next feature, credit control. One of the two major objectives of the RBI is to control credit. And price stability is the important aspect of the RBI. And to maintain price stability, credit controlling is the prime focus of the RBI. And to control credit, RBI uses quantitative credit control methods as well as qualitative credit control methods. Thus, the role of the RBI in this context is very important, as the bank is entrusted with maintaining price stability by taking suitable measures of quantitative as well as qualitative credit control tools. RBI uses several quantitative credit control tools such as bank rate, cash reserve ratio, statutory liquidity ratio, repo rate, and reverse repo rate, etc. On the other side, differential interest rate policy, credit rationing could be used by the RBI to control credit from the qualitative credit control measures. Next function of RBI is custodian of foreign exchange. The RBI acts as a custodian of the foreign exchange of the country. As of June 24, 2022, the total foreign exchange reserve of India was $59,3323 million. The bank's intervention in the foreign exchange market is to maintain stability and efficiency, which is to be considered one of the important functions of the RBI. Stability in the forex rate is one of the preconditions of fulfilling macroeconomic stabilization. As India is in the managed floating regime, therefore, if necessary, RBI may take entry in the foreign exchange market to stabilize the market. Next function of RBI, that is publishes economic data. RBI publishes statistical data on several economic variables. It includes gross domestic product at market price, gross domestic product at factor cost, inflation rate, unemployment rate, growth projections, etc. Apart from that, RBI also publishes the data on money supply, interest rate, money and banking related indicators, and the data on credit control instruments such as bank rate, repo rate, reverse repo rate, cash reserve ratio, and the data related to SLR. This big dataset of the RBI has been used by the researchers and the policymakers to frame macroeconomic policy for the betterment of the economy. Next function of the RBI is clearing house. It is one of the functions of the RBI. Through its coordination, RBI solves the mutual claims of the banks in the fastest manner. The next function of RBI is supervisory function. The apex bank RBI allows the concerned organization to commence banking business after granting a banking license to that organization. It also provides license to the existing banks to open up a new branch or shut down the same. The RBI verifies and checks all banking functions of all the commercial banks as per the Banking Acts and norms. Now we can enter to the next part of the lecture, that is monetary policy of the RBI. The monetary policy of the RBI is mainly focused on credit control, and it emphasizes the term controlled expansion. That means accelerating economic growth with maintaining price stability. In the post-reform period, the main two thrust areas of monetary policy are: number one, maintaining price stability, and number two, ensuring the availability of credit to the productive sector so that the growth can be achieved by the economy. Let me now focus on the basic objectives of monetary policy. Number one, accelerating economic growth. Higher economic growth is one of the essential conditions for any economy to flourish. A rise in economic growth would encourage producers, investors to expand output. This expansion would be only possible when they are getting sufficient credits from the bank or other financial institutions. Thus, the role of the monetary policy is very much crucial in supporting the entire growth process of the economy. Next objective, maintaining price stability. It is one of the fundamental objectives of monetary policy. Maintaining price stability is the key objective of the RBI. Without fulfilling it, an economy cannot grow in real terms. Next objective, that is financial stability. A stable and efficient financial system would contribute significantly to the growth process. Therefore, the role of the monetary policy is very much crucial in maintaining financial stability of the economy. Next point, generation of employment. In today's recessionary world, creation of employment and lowering unemployment has been the key challenge before any nation. Thus, the Central Bank of India, that is RBI, through its monetary policy, has taken several steps towards expanding employment and lowering unemployment. Thus, employment generation could be one of the policy goals of the monetary policy. Next objective, stability in the foreign exchange market. Stability in the foreign exchange rate is very crucial for fulfilling macroeconomic stabilization. Thus, maintaining stability in the foreign exchange market is one of the important functions of an efficient and effective monetary policy. We can now enter to the next part of the lecture, that is instruments of monetary policy. There are mainly two types of monetary policy instruments which could be categorized as quantitative monetary policies and qualitative monetary policies. Let me first focus on quantitative methods. This method is aimed to control the volume of the credit in the economy, through which price stability can be ensured and maintained. Bank rate, cash reserve ratio, statutory liquidity ratio, open market operation, repo rate, reverse repo rate, etc. are the key instruments of quantitative credit control methods. First, we would focus on bank rate. It is the rate at which RBI lends money to the commercial banks, and the interest on this loan is being decided by the RBI. To check inflation, RBI may raise bank rate. Currently, the bank rate is 5.15%. Data source RBI. Let us have a look at the trend of the bank rate in India in the last 10 years. This figure indicates that over the time, the bank rate has been reduced, but recently the RBI has raised this rate to check inflation. The next instrument, that is cash reserve ratio, or popularly known as CRR. It is the fraction of total deposits that all commercial banks must keep with the central bank. If this rate is raised by the central bank, that is RBI in our case, so obviously commercial banks would have to submit more deposits to the RBI. As a result, they will have less excess reserve, less credit creation, and price level will be controlled. As like the previous bank rate, let us now focus on the trend of CRR in India in the last 10 years. This data has been collected from the RBI's website. So from the figure, it can be concluded over the time span 2012 to 2020, the CRR had been declined. But this rate has been revised since 2021, and the rate of CRR as of 20th May 2022 is 4.50. The next instrument is statutory liquidity ratio, popularly known as SLR. It is the proportion of deposit that the commercial banks are required to maintain in the form of liquid cash, gold, and government-approved securities. It is one of the important monetary instruments of the RBI. If RBI wants to expand credit creation, then SLR rate should be reduced, and vice versa. As per the recommendation of Narasimham Committee, in India, the SLR rate over the times had been reduced. The trend of SLR in India in the last 10 years has been captured in the following figure. From the figure, it has been very much crystal clear to all of us that over the time, SLR rate has been reduced, and the current rate of SLR is 18%. Data source RBI. The next instrument is open market operation, popularly known as OMO. It is the monetary instrument through which RBI sells and purchases government bonds or securities in the open market. Selling government bonds by the RBI in the open market contracts liquidity and purchasing government bonds pumps liquidity into the circulation. The OMO policy could be used as an alternative to the bank rate. Next instrument, that is liquidity adjustment facility. It is popularly known as LAF. It is a short-term instrument used by the RBI to fulfill the agenda of price stability with accelerating economic growth. It is consisting of repo and reverse repo. Let me first focus on repo. The repurchase or repo rate is the rate of interest charged by the RBI to the commercial banks when commercial banks are taking loans for the short-term purposes from the RBI against of government securities. As the short-term instrument, RBI changes frequently repo rate to stabilize the macroeconomy. On the other hand, reverse repo rate is the rate at which RBI absorbs liquidity from the commercial banks against of government approved securities. To reduce liquidity in the circulation and to reduce money supply, RBI may raise reverse repo rate. Here, this figure has been used to present the trend of repo and reverse repo rate in India over the time span 2012 to 2022. In this last 10 years, the trend of the repo and reverse repo rate has been captured in the figure. In the pre-COVID situation, as of 4th October 2019, the repo rate was 5.15%, which was drastically reduced to 4.40 in the time of COVID to boost up the economy. And further, it was reduced to 4% as of 22nd May 2020. Currently, the repo rate is 4.90, which has increased by 40 basis points from 4.50 to check and control inflation. Along with the repo rate, reverse repo rate has also been modified, and currently the reverse repo rate is 3.75% as of 4th May 2022. Now we can enter to the next part, that is qualitative measures of monetary policy. Apart from quantitative credit control methods or instruments, RBI deploys qualitative methods also to check and control inflation. This method is based upon so many instruments, policy instruments. Let me first focus on differential interest rate policy. It is the qualitative instrument of monetary policy where, as per the direction of the apex bank, all the commercial banks would charge different interest rates for different kinds of credit. This is known as differential interest rate policy. This instrument would enable low-income groups and the priority sectors to get financial assistance at a concessional rate. And that would help to encourage their productive endeavors. Next instrument, credit rationing. It is the instrument may be used by the RBI to set the limit of maximum credit of the banks. The RBI may fix the upper limit for the bank to lend for a particular sector. Third instrument under qualitative credit control measures is margin requirements. Margin means difference between the current value of assets and loans granted. This instrument may be used by the banks if a borrower fails to pay back the loan amount. If margin requirement raises, then the bank will provide fewer loans to the customer. As a result, he or she will be able to invest less money in the stock market. Thus, the RBI can control the flow of credit for that particular sector. Next instrument, moral suasion. Under this measure, the apex bank can request commercial banks to take steps considering the trend of the economic phenomenon. Besides, the RBI may request the commercial banks to provide soft and easy loans to the farm and the priority sectors of the economy so that they can grow properly. The next instrument under qualitative monetary policy is direct action. The RBI can issue instructions or directives for the concerned commercial bank or all commercial banks to implement its desired goal. This qualitative measure can directly control the lending and the banking activities of the concerned commercial bank. The pandemic, worldwide uncertainty, and global shocks have become the key challenges before the macroeconomic stabilization process of India. And these have intensified the pace of inflation. As like the major nations in the world, India is also experiencing a very high level of inflation, which hurts the basic objective of achieving price stability goal of the RBI. Therefore, controlling inflation has become the major issue before the Monetary Policy Committee of the RBI. According to the governor of RBI, controlling inflation can raise the trust and confidence among the public towards economic institutions in the country. And RBI would be continued to focus on price stability over the medium term while also ensuring a strong and sustainable economic growth with macroeconomic stabilization. Therefore, the monetary policy of the Reserve Bank of India is to be placed in such a way that would arrest inflation with accelerating growth and to foster macroeconomic stabilization process. Thank you all.